Today we decode the Saradha chit fund scam. Saradha Group was a consortium of some 239 private companies that ran collective investment schemes. The group collected around 200 to 300 billion rupees from over 1.7 million depositors. It collapsed in April 2013 after running a full cycle and when inflow of money was less than outflow. Agents and investors became restless. Sudipto Sen was the chairman and managing director. In his youth, he was known as Shankaraditya Sen and was part of the Naxalite movement in West Bengal. He changed his name to Sudipto Sen, after which he started land development projects in South Kolkata, which became the kernel for duping early investors. Like all Ponzi schemes, the group promised astronomical returns. Its funds were sold on the basis of huge commissions to the tune of 25 to 40% by the agents recruited from local rural communities. Just as other Ponzi schemes, it quickly built up a white pyramid of agents. Now look at the phase 1. Initially, the associated companies collected money from the public by issuing secured debentures and redeemable preferential bonds. But under several laws, a company cannot raise capital from more than 50 people without issuing a proper prospectus and balance sheet. Also, its accounts must be audited and it must have permission from the market regulator Securities and Exchange Board of India, which is otherwise known as SEBI. SEBI confronted Saradha Group in 2009, but the group adapted by opening up to 200 new cross-holding companies to create an extremely complex tiered structure to confuse SEBI. Next is phase 2. SEBI continued its investigation. Now the group changed its modus operandi. In West Bengal, Jharkhand, Assam and Chhattisgarh, it started operating tourism packages, forward travel and hotel bookings, timeshare credit transfer, real estate, infrastructure finances and motorcycle manufacturing. To evade SEBI, there was another set of investors whose money was collected through chit fund. Under law, chit funds are regulated by state governments rather than SEBI. Finally, phase 3. SEBI warned the West Bengal government about Saradha Group's chit fund activities in 2011. Saradha Group again changed its modus operandi. This time, it acquired and sold large numbers of shares of various listed companies. The proceeds were then embezzled. Meanwhile, the group also started laundering funds overseas. By 2012, SEBI caught the group by the neck as it classified its activities as collective investment schemes rather than chit funds, thereby bringing it under its purview. Saradha Group did not comply with this ruling and continued to operate until it collapsed in April 2013. Let's look at the investment scenario. With enormous funds at disposal, Saradha invested in high visibility areas such as the Bengali film industry. It roped in actors and TMC MPs Shatabdi Ray, Mithun Chakrabarti as its brand ambassador. It enlisted TMC MP Kunal Ghosh as the CEO of the media group. This group-owned media company owned 8 newspapers printed in 5 languages. It also owned Bengali news channels, Bengali entertainment channels, apart from a Punjabi entertainment channel, an international channel and an FM radio station. In 2011, Saradha Group bought debt-ridden Global Automobiles to serve as a front for its Ponzi scheme. Though Global Automobiles stopped production, but 150 workers were kept on rolls to pretend to be working whenever prospective depositors came to visit. It also bought over shell companies to hide its reality. As part of its corporate social responsibility initiative, the group donated motorcycles to the Kolkata police apart from ambulances and motorcycles to the Jungle Mahal area of West Midnapore. To get respectability, it also invested in well-known football clubs in Bengal such as Mohan Bagan AC and East Bengal FC.